Okay, if you've been watching the markets at all, you know we've all been holding our breath for one thing: interest rate cuts. But, well, on January 28th, the Federal Reserve threw a major curveball that basically rewrote the financial game plan for 2026.
That's right, paused. For anyone out there who thought the soft landing was a sure thing and that cheap money was coming back, nope. The Fed just hit the brakes hard. All those rate cuts we saw in late 2025, they're on ice.
And this right here is the number that now rules our world. The federal funds rate is locked in. And you might think, okay, so what? Well, this single decision ripples out and touches your mortgage, your savings account, your credit cards. It touches everything. So let's get into what this actually means for your money. So the big question on everyone's mind is why? Why the sudden stop? Well, the Fed is basically in wait-and-see mode. Think of this pause as their way of saying, whoa, the economy is running a little too hot, and we are not about to pour gasoline on that fire by cutting rates. And it all makes sense when you look at the numbers. The economy, it's showing solid growth. The job market, pretty stable. But here's the real problem, the kicker. Inflation is just stuck, hovering around 3%, and that is still higher than what the Fed wants. They just can't risk cutting rates until they are absolutely sure that number is heading down for good.
I just love this analogy because it's so perfect. It really captures the bind the Fed is in, right? If they cut rates too soon, that sticky guest, inflation, never leaves the party. It just hangs around, eating away at your purchasing power. So they're choosing to be cautious, even if it means borrowing costs stay higher for a little while longer.
Okay, so let's bring this home, literally. What does this all mean for the biggest purchase most of us will ever make? Yeah, we're talking about real estate. This higher for longer world has a direct, and I mean direct, impact on your mortgage payment. And here it is. This is the number that's giving a lot of people headaches. With the Fed holding the line, the average mortgage rate is parked at about 6.1%. And you know what? That is a really tough pill to swallow if you are hoping to buy a home this year. This really means we all need a huge mindset shift. I mean, if you've been sitting on the sidelines just waiting for those dreamy 3% rates from a few years ago to make a comeback, it's time for a reality check. The truth for 2026 is that you've got to plan for a world where 6% is the new normal. And this might be the single most important piece of advice for anyone looking to buy a house in 2026. Please do not bet on some future refinance saving you. If the monthly payment doesn't work for your budget today, right now, then it's a bad deal. End of story. The numbers have to work now. But what if you're already a homeowner? This whole situation creates a totally different question. If you bought a home and rates were even higher, maybe you're sitting on a rate over 6.5% or even 7%. Well, now is absolutely the time to pull out your calculator and run the numbers. A refinance down to around 6% could save you some serious money every month. Okay, enough doom and gloom for borrowers. Let's flip the script because there is a huge silver lining here. While high rates are tough on anyone with debt, they are a golden opportunity for savers. Seriously, this might just be one of the best times in decades to actually get paid on your cash. I mean, just look at this difference. It's wild. Your traditional big-name bank is probably paying you, well, basically nothing. Meanwhile, high-yield savings accounts, or HYSAs, are offering these incredible returns. Some are pushing 5% APY. And the best part? It's completely risk-free. Your money is just sitting there making more money. Let's make that real. Let's say you have $10,000 sitting around for an emergency. And a high-yield savings account earning, say, 4.3%, that's an extra $430 in your pocket at the end of the year. That's real money for doing nothing more than putting it in the right account. Now, what if you leave that same $10,000 in a traditional savings account? You ready for this? You'd earn about $1. $1. In fact, with inflation still near 3%, your money is actually losing value every single day it just sits there. The urgency to get your cash into the right place is absolutely real. So, what's the right strategy here? It's simple. First, your emergency fund. That's your 3 to 6 months of living expenses. It belongs in a high-yield savings account. Period. But just remember, cash is for safety. It's your buffer. It is not your wealth-building tool. A 5% return is amazing for safety, but your long-term investment dollars need to be working even harder for you in the market. Okay, so we've covered the Fed's big pause, what it means for your mortgage, and the huge opportunity you have with your savings. Now, let's tie it all together into a simple, actionable playbook that you can start using today.
All right, here we go, your 4-step plan. Number 1, as soon as this is over, go online and compare HYSA rates. It takes 5 minutes. 2, if you're a homeowner, actually run the numbers on a refinance. 3, top off that emergency fund. Make sure it's ready. And 4, keep your eyes on the Fed's next meeting in March. That's where we'll get our next clues.
And one last thing. This one's about your mindset for your long-term investments. I want to leave you with this idea of the volatility fee. When news like this makes the markets go up and down, don't panic. Don't see the dips as a loss. See them as the price of admission. It's the fee you pay to get those incredible long-term returns. Staying in the game is everything. So here's the bottom line. The Fed's pause has created a clear divide. There are going to be winners and there are going to be losers. This playbook we've just walked through, it's all about making sure you land on the winning side. The financial landscape has shifted, for sure. But if you have the right strategy, you can absolutely come out on top. So the only question left is your money ready?